Good morning. The CRE reset in 2026 will reward patience and not aggression. Commercial real estate is resetting, and the investors who outperform in 2026 will not be the most aggressive buyers, but they will be the most disciplined and patient allocators of capital. We're in a market of transition and not a collapse by any means. And the current commercial real estate cycle is not a repeat of 2008. Instead, it reflects a prolonged repricing phase driven by tighter liquidity, lender retrenchment, and higher for longer interest rates. Transaction volume has slowed and bid ask spreads remain wide, and many owners are choosing to wait rather than sell into uncertainty. And the environment is creating frustration for impatient buyers, but also opportunities for the patient ones. Liquidity cycles always decide the winners. So, real estate cycles are ultimately liquidity cycles. And over the past decade, cheap capital masked weak underwriting and compressed cap rates. And now that that liquidity is gone, for now, things are looking different. Banks are pulling back, CMBS issuance is selective, and bridge lenders are cautious. Private credit is demanding structure and yield. And this contraction is not permanent, but it's meaningful. And historically, the best risk adjusted returns in commercial real estate occur after liquidity tightens and not before it returns. So, lender pullbacks are creating forced decisions, and refinancing risk is the pressure point of this cycle. So, we have owners that are facing near term maturities, others that have floating rate debt, and others that have declining NOI with massive increase in insurance and other expenses, but also sponsor fatigue. And people are being forced to make decisions that they delayed in 23 and 24, and some will need to inject capital, others will need to sell, and a smaller but growing subset will quietly default. Now, these are not fire sale conditions, they are timing driven opportunities. And distress will be uneven, and that matters. So there will not be a single moment of mass distress. Instead, opportunity will surface in pockets. So one of the ones I'd point out is secondary office assets with broken capital stacks, or multifamily projects delivered into peak supply. As well, value add deals that relied on cap rate compression may not pencil anymore, and owners who overestimated their rent growth velocity. And sophisticated investors understand this. And you don't chase headlines, you track maturities. You look at loan covenants and you look at sponsor behavior. And why aggression is the wrong strategy right now. And aggressive buyers often are willing to overpay to win deals. And they're underestimating their hold risks. And they're also most likely going to assume rapid rate relief from the Fed. And there could be compressing margins prematurely. Now, in contrast, the patient capital is preserving their liquidity and underwriting deals conservatively and also structuring optionality at exit. And the key point here is they're waiting for clarity, not confirmation. And the spread between these two approaches will define performance in the next cycle. 2026 is when the discipline's going to get paid. And by 2026, the market will likely have clearer rate direction, and we have two rate cuts coming. Likely, we're going to see some more stabilized lending standards, and I'm hope more realistic pricing expectations from the buyers and sellers. And also, there'll be motivated sellers with time pressures because of maturities. And those who preserve their capital and relationships during the slowdown will be positioned to move decisively without chasing any additional risk. And the bottom line for investors is this is not the cycle to force deals, it's the cycle to sharpen your underwriting, strengthen your capital stacks, and build your deal flow quietly. Patience is not passive, it's strategic. And it's time to sharpen the axe. That is it for the day. Please visit Houston Real Estate Brokerage to figure out how to get a hold of me, and I'd love to talk more. Take care.